会气，然后就是还有饭，然后吃饱做了。刚想说不好吃，热饭这样子。
Okay. Yeah, and if you come back and if you go there, no one will say.
I'm not in charge here. Yeah. Oh, you got balls? You're doing balls? Yeah.
Oh, my friend. I like finding
What are you saying?
Yes.
Sorry.
Right now it's not even recognizing like whatever it was, just because the USB extenders for this aren't very good.
What if we restarted the phone?
Possible. Try it. Where do you know where it is? I wonder where the
The link for?
The Zoom
Zoom
meeting.
meeting. Yeah, it seems
I just started the Zoom meeting here. I did not have a link.
Oh, I see.
Okay,
just
so we'll
recording
just do
it.
a random one. Okay.
Yeah.
Oh, you're just recording it. Oh, I
I'm
see.
recording it for outsourcing, so it's not like a live.
Oh, well, the Apple's
Oh,
doing that
okay.
perfectly.
Yeah,
Right?
we can do that. But we'll see if we can do this.
That's how you do it. That's how you Just give you like.
So you just did a new meeting?
Yep. That's it. Just making sure we record it. So we were trying to figure out the live broadcasting because
It's the microphone because the AV bridge that connects to the cameras and the microphone system is not working. We always just into the PC, but now I got the speakerphone to work because the microphone is not working, and now because it's also not recognizing through the USB because of the extension system for PCs. But I mean, if it's just for recording purposes, it is recording on like a 360.
Yep. And I think when I tried by myself. I recorded the Zoom and it worked fine. I did record the sound.
Right. Yeah, it's just it will work. It's just the fact that it's just not. There's there's an issue with the audio. There's no microphone here right now. So it won't be actually recording the sound. It will not. No, because it's not recognizing. Yeah, through Zoom.
But if you put this on, for example, and it's Echo 360, the recording will have.
Yes, yeah, the Echo 360 recording, which is our lecture capture system, that is recording and it's recording right now. So that is going
Okay.
So it seems like if you are presenting,
But can I have an external link?
Yeah, we could. Well, I think are you the professor from the course?
Is the guest speaker?
The guest speaker? Oh, okay. Yeah, we have to get permission, but yeah, we could provide that recording for your purposes.
I see. Okay, because this was the main, because I wanted to share it externally, the Zoom. That's why we also recorded.
Right.
So, okay.
Right. So we can share it externally. A file with the presentation you need to. Right now, it just doesn't look like you're getting with your devices to connect with Zoom. So you can record it. It'll record the video, but there won't be any audio.
No, of course.
you just because this is what so if you put
yeah, well, presentation we record and the camera from the back.
Yep.
And then of course.
That already $10 back.
Anything else? No? You're good? Okay.
Just email mmgroup@gsp.com to say to remind you about getting back to the smallest screen so I can just see the Zoom. Is it recording? Do we need to record?
Recording in progress.
That works. You know about, right? How did you
exit full
exit full
screen?
screen? PowerPoint. Okay. If we want to go to the video, we have it here, right?
How are you?
And was the clicker moving?
Yeah,
Oh,
I think so, yeah.
and then you have your YouTube.
Why is it skipping a slide? I think maybe this one for complete full screen. I want to see without the full screen. Check it for a second. Reading. Order is weird. How do I get back to the
Just
regular?
maybe do outer and the slide.
Did we close the PowerPoint? Because I made a few changes. Okay, fine. Yes. Okay. And I just need this. Yeah, I think so.
Anything else, let us know, okay?
Yeah.
Goodbye.
Take care. Go get some pizza too.
Yeah, get some pizza. All right, everyone, good evening. We'd like to start. So this is Yoav Zelikovic, and he's gonna proceed with today's lecture. And I'm very honored to have Yoav here. For those of you first years, who's first year here? Okay, yeah. Nice to meet you all. Tom from SEMA. And so we'll have a great discussion with Yoav. I just want to, let you know that we'll have a presentation of about 50 minutes and then Q&A. So if you got some questions, you could maybe ask through the presentations if you got, or save them for the end, and Yoav will be happy to entertain questions. So, yeah, let's go.
Thank you. Thank you, Tom. You hear me okay? Good, thank you. Good evening. Continue reading. Feel free. As you see here, I called the talk Value Investing from the Holy Land. I landed just this morning from Israel. So first of all, you have to excuse me for me. It's still the middle of the night. First, my name again is Yoav Zilikovic, for who didn't hear. First, it's a great honor for me to be here and talk about what I do and what I've learned over the years as an investor. Mainly working out of Israel to be, I'm sure you guys know where you're studying is where the whole value investing started, where Benjamin Graham taught Warren Buffett, and many great investors afterwards came and studied and taught here. So it is really a great honor. Thank you for Tom for making this possible and bringing me over here. It's fun, and I hope you enjoy the talk I prepared for you. You also have to excuse me, although I grew up in Seattle, Washington, on the other side of the country, but I've been living in Israel for the past 30 years, so my English is, I hope I didn't forget it. You'll tell me at the end of the evening, so you excuse any typos I may have. But with that said, let's begin. I'll give you a little background just about myself, investing and so forth, just so you know how come I'm even standing here today. So I'm 44 years old. I got a huge compliment on the way somebody thought I was a student here, but I think I'm too old for that already. I'm a lawyer, corporate lawyer by trade. First of all, before everything, I'm married and the father of two wonderful children. As I said, I live in Israel today, but I grew up in the States. By trade, I'm a corporate lawyer, but I also have a license today to manage portfolios. In Israel, there's like the local SEC in Israel. There also to manage money, you need a portfolio, you need a license. So I have a license. I also I manage a hedge fund as well today called Tavo, and I also advise a mutual fund. And we'll talk about what we do in the mutual fund soon. What else did I want to tell you about everything? I did get an MBA, which just like you, from Bar Ilan University, but I didn't have any formal investing education, you may call it. So I'm pretty much self-taught. So you guys should be really privileged that you have such a program that's teaching you how to invest, because I had to read all the books on my own, which is also great, but it's probably better that you get a great formal education. I did work a couple of years, had the luxury of working at a large investment firm in Israel. And about that, I wanted to show you a small video before we start, just to show you how I felt when I was working at this investment firm. So let's hope this works. This is rated R material, so for anybody that this may not be appropriate, now is a good time to say that. 1 second, let me show you the video. 1 second. We'll get the green button in a second. Do you know how to put the video? Yeah, thanks. If you can, because it's. Sorry, 1 second. Great. I told you I have a jet lag. Takes some time. Okay.
Welcome.
Steve here yet? This was the day that we launched the Steve Madden IPO.
Troops are out here. Everyone's all rallied, excited.
Everything had to run tight. It had to be perfect.
What the fuck is that kid doing? What's he doing? Biggest IPO in this firm's history. What the fuck is he doing?
See?
The Wolf of Wall Street. Yeah, I'm sure most of you have seen it.
How you doing?
Good.
Hey, you cleaning the fishbowl?
I had a minute and
You had a minute. And today you needed to clean the fishbowl today?
I had finished my paperwork and so just had a couple minutes.
Okay. Nice to meet you. A new issue day! A cocksucking motherfucking new issue day! This is what you do! Hey, everybody, listen up! This is what happens when you fuck with your pets on New Issue Day.
Okay, enough. I don't want you to throw up your pizza. So that is. We'll go back to that. Thank you. All right. Now, why in the world did I show you that? I owe you an explanation. So when I worked at this leading investment firm in Israel, I kind of felt like the guy with the fish. Okay. The people around me all day were buying and selling securities and screaming, "Let's do this, let's do that, let's do," and all I wanted to do was read. Okay, and so at one point, my boss kind of got mad at me, and she didn't eat my fish, but she fired me. So I really had no choice. So I'm talking about like 10 years ago. So I had to set up my own shop. And what I do today, together with my partner, who is not here today, we actually tried to start from scratch, to apply everything I'd learned up until that point. And of course, value investing, as you understand, is the path I chose. We'll talk about what exactly we do, but I did not have the privilege, as I said, to have, I had to go against the grain, which many times value investors have to do. So the fishbowl, remember the fishbowl? Not every time you work, your first job will be at a place where they'll talk like your professors here, so I'm just getting you ready for that. So about 7 years ago, as I said, we set up our own fund. We started applying what I had studied and thought was the right thing to do, and we've done pretty well. Again, this is too short term, but our mutual fund has been placed in first place in our category for the past couple of years. Not every year, of course, but total return has been pretty good, above the benchmarks, and I think that allows me to a little bit to speak, maybe to show you how we've been successful in a very difficult time for value investing. Okay, that's why I think I wanted to call this subtitle "Make Value Investing Great Again." For different reasons, a lot of people have been calling definitely the deep value investing. I'm sure you guys are familiar with that it doesn't work anymore, or that it's not applicable, and then all you have to do to buy the S&P or the NASDAQ, or just buy NVIDIA, and you're done. So and now we're getting to the essence of what I really wanted to call this talk, and you'll have to bear with me and use a little bit of your imagination here. I wanted to call it the price paradox, and I will explain using the words of another guy you probably are well aware of. Warren Buffett said this a couple of years ago. Anybody want to read, so I won't get boring? I'll read for you, but at the end I'll need some participation here. It's a little late at night. I don't want you to fall asleep. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Okay, what's Warren Buffett telling us here? Have you guys heard this? You heard this? Yeah, he's telling us, and this is very exemplifies what he does today when he invests. He's not buying so-so companies. He's buying really, really good price companies. And he's buying them at not a really cheap price, but a fair price, as he calls it. And he says that's better than buying a crappy company, I'll take it to extreme, at a really good price. Okay? By the way, also when he bought Apple a couple of years ago, it's a wonderful company, but it didn't wait until Apple used to be a net. Are you guys familiar with that strategy? We'll talk about it later. But Apple used to be a net stock, which is like deep value. Buffett says, I'd rather buy Apple, a great company like Apple today, at a fair price than otherwise. Now, I'll explain in a second why this is a paradox. But I'll show it to you now already. Look at Buffett's returns in the beginning of his career. Okay, I don't know if you're able to see the numbers, but when Buffett was managing his first hedge fund in the 1950s and 60s, he was compounding. His returns were almost 30% a year. He was doing like more than twice as much as a Dow at the time. He's saying here he did this when he was managing small amounts of capital. But what was he doing here when Buffett started off? He wasn't buying great companies at fair prices. He was buying really crappy companies at really, really, really good prices. Like who taught him? Like Benjamin Graham taught him. Now, what I wanted to explain this. It's kind of the how do you say in English? The kind of the decision I had to make a few days ago when I had to go buy some diapers for my newborn baby. My on the one hand, you can buy like the best Pampers diaper at a really high price, but you know you're getting a great merchandise. On the other hand, you can buy like the old Pampers or even a company, I don't know, another company of diapers at really for half price. It's not such a good product, but you can buy it half a price. So what's better? Any of you have an idea? Like anybody have kids other than Tom and I? Anybody else have kids here? Yeah, great. What would you do? What's your name? Oh, nice to meet you. What would you do in this situation? Your wife would probably tell you to buy the expensive stuff, right? And that's what you would do. So, and that's what Buffett, we'll see soon, that's what Buffett does today. But I agree with me that economically speaking, and Warren Buffett's returns in the beginning show this, that the highest returns he had, Buffett today, his returns have slowed down to about 18% a year, because today he's doing larger numbers and different strategy. We'll talk about it. But agree with me that economically buying a so-so product for really, really cheap is probably might be a better deal. Remember this question, we'll leave it for later. I want to slowly, we'll get to the paradox, but the question still remains is this true? Is this statement, again, we're going to try to answer this by the end of the evening. What is better, to buy a wonderful company at a fair price? Remember the Pampers idea, or a fair company at a wonderful price? Let's go on to talk about another investor who also taught here, I understand, who doesn't teach anymore, Professor Greenblatt. You've heard of him, I assume. He wrote a few great books on investing. The one I want to talk about today shortly is called The Little Book That Still Beats the Market. Have you heard of it? Joel Greenblatt says something very, very simple in his book. He came up with a formula based on Warren Buffett's teachings and Benjamin Graham. He said, let's buy both companies that are cheap. He used EBIT to the EV, and he said, let's buy companies that are also profitable, that they're also making money. That makes sense, right? Let's find companies that are not only they're cheap, but they're also profitable. Buying the Pampers product, the premium, and a great price. And then he said, what happens if we would divide all the companies in the U.S. and trade at the stock exchange and give them two grades, one grade by profitability and one grade by price. And the 25 or 50 stocks or companies that got the best score, once a year he would invest in them. And then at the end of the year, he would look at the list again and rebalance. You're familiar with this term? And some stocks would be exchanged. And the returns he got by doing this simple formula were outstanding, north of 30%. Never mind that nobody's ever been able to replicate these numbers. And after he wrote the book, What Happened to This Strategy? It stopped working. But the idea is still there, okay? Buying companies are both cheap and profitable. And by the way, also, when he did this mechanically without doing it with doing too much analysis, is buying the stocks that the computer gave, that gave him the best returns. Interesting, but why am I telling you this? A couple of years ago, two guys, one called Professor Gray, and I personally have had the privilege of meeting him, and Tobias Carl wrote a book called Quantitative Value, and they tested Greenblatt's magic formula, and they found out something interesting. Everybody heard of this book, read this book? They know what you found out? They wrote about the magic formula, and they said Greenblatt did a great job, but one of the parameters in the book is superfluous. That's still a word in English? Superfluous, right? Which one is superfluous? What do we not need? The profitability? When will the strategy work better? If we do only cheap or only profitable? What did they find? They found that sticking with only the cheap doesn't make any sense. Forget profitable companies. Just buy the cheapest stocks in the universe. Your returns are going to be higher. They added a few parameters to take out the junk. I'm kind of simplifying, but the point is that buying a basket of stocks that are quantitatively cheap, according to, they used EBITDA to EV. That was the best metric they found. But any way you do it, also PE, price to free cash flow, all that stuff works. And I'm talking about returns that are north of 18% a year. Show me how many investors have such a track record over time doing something so simple. One more example before I move on, if we can. I'll also show you a few live examples that we do. We talked about Joel Greenblatt and we talked about Warren Buffett doing net nets. And early on in their careers, the numbers, when they put up the really big numbers, they were buying net nets. Net nets, I remind you, the formula is you're looking for companies where their market cap of the whole company is lower by a certain margin, then you take all the company's, all of their total, only their current assets, meaning if companies have long-term assets, real estate, I don't care about that. You take only their current assets, subtract all of their liabilities. By the way, there's a mistake here, and it's my mistake, not current liabilities, all of their liabilities. So you take all of a company's current assets, meaning cash and cash equivalents, inventory, and all the and then you subtract from that all of their liabilities. The number you come up with, that's the net working capital of the company. And Benjamin Graham, who taught this class here many years ago, would this is what I remember I read somewhere he would do. He'd give his students live examples of net. So I'm going to do that for you now as well. But this strategy is probably, I'm not sure you can see it here, but over time returns of north of 40%. This is from Greenblatt's original hedge fund. This is the numbers he put up. So crazy numbers. And just so you think it's not only academic, I brought two examples today of stocks that we are still invested in. I'm not sure I'm allowed to talk about real stocks, but I manage money in Israel, so I don't care. The SEC is not going to come stop me. Look at this company we invested in. It's actually an Israeli company that's listed on the NASDAQ. It was a failed SPAC. Okay, when we bought it, it was trading at about half this price, about $60 million. And it had, as I said, current assets of 165. Again, mostly cash. Sometimes inventory can be worthless, so you got to be careful. But in this example, so you take 165, you subtract about 30 million, you get 135, and you were buying it at 60 million. Now, look at what happened since we bought it. We bought it at around 76 cents. Today, I don't know, up to a few days ago, it was trading north of 100%. So people tell you these don't exist anymore. As you can see here, these stocks still do exist. A lot of them happen to be not in the U.S. A lot of them that you can find today in Japan. Of course, you can't buy all the net nets. Be careful if you want. There's a great book on net nets other than secure analysis. There's a book called Net Investing by Evan Blecker if you want a good book. At the end of the lecture, by the way, I'll give you a few good books if you want. I recommend. But you can't buy all the net nets. You got to make sure they're not burning cash. They're not diluting shareholders. But this strategy, if implemented carefully, and can still create outsized returns. Okay, we finished section 1. You ready for section 2, or you want to go back to eat salad and pizza? Because now I want to get to the paradox, okay? So what is the paradox here? Remember the beginning. What did I tell you Warren Buffett said? He said, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Okay, so we just showed now that Warren Buffett is saying something that doesn't make sense, okay? His best returns were when he was buying fair companies at wonderful prices, even crappy companies at wonderful prices. How can he say such a thing? Let's try to understand, first of all, what made Buffett switch to this strategy, who made him switch, and let's try to understand what's going on here. Charlie Munger, another smart dude. I don't think he studied here, but believe me, he's one of the smartest dudes alive. It's a long quote here, but it's important we understand it, because Charlie Munger is the one that made Buffett kind of switch his strategy from the deep value to buying the wonderful companies. Charlie Munger says, I'm going to continue reading because I want you guys to try to understand what he's saying. Over the long term, it's hard for a stock to earn a much better return than the business which underlies its returns. If the business earns 6% on capital over 40 years, and you hold it for that 40 years, you're not going to make much different than a 6% return, even if you originally buy it at a huge discount. Conversely, if a business earns 18% on capital over 20, 30 years, even if you pay an expensive-looking price, you'll end up with a fine result. Interesting. What's Charlie telling us? He's saying price doesn't really matter. What matters is the underlying company. we'll try to explain this discrepancy over at the end of the soon, but I want you to give you a few examples of why does Charlie say this. By the way, it's a great paper. I don't remember where. If you want, I'll try to send you the bibliography when I get back home. But there's the great mathematical article where somebody proved this, that over time, a stock's return over long periods of time will be not directly linked to the return on equity of the company, but over time these two must converge. If a company is going to have, as Charlie Munger says, if it earns 18% on capital, over 20, 30 years, the stock of the company is going to go up 18, 20%, even if you bought it at a high price, as Charlie says. I'll show it to you in a second. But in order to understand Charlie, I want to bring another investor over who I've personally met, Chuck Akre. Anybody heard of him? He's one of the best out there today. I don't know how, he's not really well known, but I had the privilege of meeting him as well. And he defines wonderful companies. He calls them compounders. Okay? What is a compounder? He uses an approach called the three-legged stool. If it's too much information, we get to the punchline if you want. I see you guys are still nodding, so we're okay. I'm trying to give you as many good investors, and don't worry, I will give you good investments that we own also in this approach. Compounders, wonderful businesses. What is a wonderful business? So Chucky, as I am allowed to, by the way, just a small story, just so you know how I had the privilege of meeting such a great investor. I know, have any of you been to the Berkshire shareholder meeting in Omaha? Oh, great. Tell me you've been as well? Good for you. So I also went a couple of years ago. Also, I came all the way from Israel. And around the weekend, the guys have been there, they have like meetings of other investors who come to speak, not only Warren Buffett. So one of the conventions before Warren Buffett's meeting was Chuck Akre gave the keynote talk. And they had a raffle. There were hundreds of people there, and I had paid like a lot of money to go participate in this event. And they had Warren Buffett each year has like he donates to charity to have lunch with him. And how much the last one's $2 million already if you want to eat lunch with him. Chuck Akre was willing to do it for free. So all you had to do was participate in this event. I didn't know about it ahead of time, and your name had to come up in the raffle. And luckily enough, whose name came up, and I had it was huge. But he started reading the name. Automatically, I knew it was me because he couldn't say my name, so I knew how many people from Israel were there. So I had the privilege of having lunch with Chuck Akre for free. I couldn't eat anything there because it was a Jewish holiday, but he was eating his cheeseburger, and I had my salad. But he talked to me about this, what I'm telling you right now. And you can also find this talk on YouTube. He explains it very well, but I heard it, as I said, I had the privilege from here. What is a wonderful company? 3 things, very, very simple. Notice what's missing here. Can you see what the 3 things that are missing, that are written down? What is not written here? What price? Interesting. Leave that thought for later. Thank you. 3 things he calls them. Chuck Akre says, first, we'll call it business. A business, of course, an above-average business, not only a business. A compounder has to be an above-average business. What does that mean? He defines above-average companies as companies that over time, their return on equity is above the return on equity of the average. Wait, I'm on the left side. What about this side? I'm sorry, guys. The above return on equity that's higher than average. The average return on equity of the company in the U.S. over time is usually 13, 14%. So any company that over time shows that it has the capability of making return on equity which is higher is already an interesting thing to investigate. How does this company do this? Companies that do this over time, MasterCard, Visa are large holdings of Chuck Akre, including a few other companies we'll talk about. Second thing, management. A good management team. Of course, all management teams are going to be smart and they're going to be super sophisticated and self-promoting, but a good management team is one that does the third thing very well. We'll talk about in a second. But they treat their shareholders as partners, okay? They don't talk the talk of Wall Street, even though we're pretty close to Wall Street. They don't talk about earnings per share. What do the great investors prefer? What is the metric that is usually used? Go down. What is you have the balance sheet, you have the income statement, and the third one is the one they usually talk about the most: free cash flow or cash flow per share. When you find a company whose management talks about free cash flow per share, they're already in step in the right direction. But mainly, again, this is not an objective test. You got to find management teams that over time have treated their shareholders well. They don't pay themselves a huge salary unless the company does very well. Your interests are aligned. But the third and the most important thing of a wonderful company over time is the reinvestment opportunity. What does that mean? Okay, and this really, if there's one thing I want you to take from this talk is that this is really the essence of investing. If you want to hold a company over the long term, the most important thing is not how profitable the company is now and not what price you pay for it now. It's what this company can do with its profits. If it can reinvest them again at high rates of return and do it again and again and again, even when they get slightly larger, that in a nutshell is the most important thing. Okay, that's the essence. And you can see it also from one of Chucky's, one of his largest holdings, and we hold it as well, a company called Constellation Software from Canada. I see a few of you are nodding. Mark Leonard is still the leader of this amazing company. One of the companies that's gone the fastest from, the stock has gone from $1 to 100 in about 20 years. That's a 100-bagger. Great book, by the way. We'll talk about that. And this company is led by one of the best capital allocators, meaning Mark Leonard, who he decides how to invest this company's profits. What they do is they invest in vertical software companies, and they just buy lots of companies and integrate them. But what they do is they buy them at good prices, by the way. We're talking, if we can put price in here, and just do it again and again and again. They're already like a 40 billion market cap. But look what Mark Leonard says. The key, or he says a huge chunk, I call it key, of Constellation value is premised on the redeployment of our capital intelligently. Okay, he says it, not me. Let's find a few. If there's one formula, if you want to, for those of you, I know it's getting late, but if you want a formula to try to, this is actually part of the formula, but this is important for you. If you want to try to calculate whether a company over time is allocating capital well and reinvesting well, all you have to do is you have to do this over long periods of time, not 1-2 years. You need usually probably a 10-year period is best to see how much money the company is making. I use Notepad here. You can use free cash flow. It doesn't really matter. See how much that free cash flow has increased over this time in relation to how much money has been invested in the company. Remember, the best company is the one that can reinvest lots of money, but do it at high rates of return. If I'm investing in a bad project and it's profitable, I'm not doing a good job. Okay, so you need both to reinvest and do that at high rates. Okay, that's the key of the compounders. Here's another compounder for you, and this is where I want to try to get to the punchline. So if you're still with me, hang in there for a second. Okay, we're nearing the end where you can start asking me the hard questions. Don't worry, I know you're tickling to ask me the good questions. This is a great company to use called Fairfax Financial from Canada. Anybody heard of it? Led by a great investor, Prem Watsa, from Toronto. He did something ingenious, okay? And when he started this company in 1985, Warren Buffett was already pretty well known, and Berkshire Hathaway had become a large company. And Prem said, okay, I understand Warren Buffett set up an insurance company. He did it very well with investing. I just want to do the same thing. So he set up his own insurance company, and he's been very successful. The stock of Fairfax has compounded at over 16% a year. It goes up and down like every stock, but over time you can see that the book value of the stock has gone up almost 18%. The stock at actually by this year the stock is up a lot for us. So I'm sure also the stock returns are pretty close. But that's not my point here. What I want to show you, remember, Warren Buffett said that, what did he told us? That he said that the price, when you buy a really wonderful company, the price isn't that important, right? So this is a great example to see that. How do we see that? Let's look at this company. When it just started off, when it was trading at $3, when the book value was $1.50. Book value, you know what. You're good with these terms already, right? So it's trading at a premium to book value, which is usually value investors hate paying more than book value. Definitely don't want to do that. Definitely not pay Like in where was that I saw it was paying? In 1993, it was trading almost 3 times its book value. Crazy valuations. But I give you the following point. Let's say an investor bought Fairfax at this price in 1993. Today the stock is trading above $1,000. He's made more than 10, 20 times his money. And he paid a pretty high price. So I'm not talking about NVIDIA type high prices. Yeah, when you pay 100 times earnings and that kind of stuff, you're usually going to blow up. But when you're buying a really, really wonderful company that compounds at high rates, even if you pay up a little bit, and I know I'm saying things that might make your professors bleed because you guys are hopefully all be studying value investing and it doesn't make sense. But as you see here, the math works out that the company look, the book value started at $1.50, today it's over 700. Okay, so you pay up a little bit for that company, but again, you had to know ahead of time this is what would happen. But that's the beauty, to find these companies when they're just beginning. And by the way, Fairfax is not a huge company. It's about $20 billion. It's not like it can't keep growing. Not that I recommend it, because I'm not sure I'm allowed to. But again, one of our holdings, okay? So remember, this is a great example of what Warren Buffett told us. Wonderful company, fair price. I want to, before we end, share the following story with you to make this point clear. Have any of you guys heard of Robert Kirby and the coffee can portfolio? No, it's not so famous. I'll tell you the story. Good, at least like giving you something new. We're okay with time, a few more minutes. So Robert Kirby was a money manager who worked in the 1980s, I believe, in the States. And he had 2 clients, a husband and a wife. Okay? Now, they paid him for his consultation, and he would tell them buy and sell some stocks, and the husband would go and do what he said. Robert Kirby said buy HP, he would buy. He said he would tell them to sell HP, they would sell. The wife, however, was much smarter. She looked at all the recommendations that Robert Kirby gave her husband, and in her own portfolio, she bought all the stocks he recommended. But with one small difference. When Robert told them to sell, she didn't sell. Okay, and then the husband passed away about 10 years later, and Robert Kirby talked to the wife, and he saw that her portfolio was actually consisted of all the stocks he had recommended without any sales. Now, which of the stocks did better, the husband or the wife? The husband who sold some, or the wife that didn't sell anything? The wife, she's a smart lady. There were some stocks there that one stock had gone up, I don't know, it was like 30 times the original value, and it was worth more than the whole portfolio that the husband owned. Again, she just buying, not touching, and some of the stocks went to 0, some went down some 50%, but the portfolio on the whole, where there was no messing around, by sheer luck or Robert Kirby's success, he actually bought, I think, HP for her in the beginning. It was one other company that was worth much, much, much more. So the point here is when you buy a really wonderful company, Charlie Munger says the best thing to do is, in Hebrew we say, you sit on your tuchus, you sit on your ass, okay? Do nothing when you have one of these. And this, I think, the story exemplifies it. These are just, before we finish and before we answer, how can both these strategies coexist? A lot of companies that are able to reinvest their earnings at high rates are, as I told you about Constellation, companies that are very acquisitive. Buying other companies is an art in and of itself. Most companies do this very badly, but there's a select few, and some of them are here. A lot of them aren't American companies that do this very, very well. And these are companies that can and should be studied. There are a lot of papers on this subject. If you want, I can send them to you as well. We own a couple of these as well. Again, and it'll do a lot of the reinvestment rate. So our solution, anybody, before I give our solution, do we all, any of you want to give your own? How do you reconcile these two things that Warren Buffett says? On the one hand, he tells us to buy these great companies at decent prices. But on the other hand, we see that as best returns, we're doing something a bit different, buying crappy companies at outstanding prices. Any of you have any experiences that make you think one way is better than the other? What would you do? Any solutions for this? You understand there's a slight contradiction here. Okay? Any solutions? Let's do raise of hands, okay? Which one of you would do the first part of the lecture, which buying the Pampers for half price? I'm there for now. The Pampers half price, and which of you would prefer Warren Buffett B, where he'd buy great companies and doing nothing? Okay, so we are split. That's great. There's not one right answer. By the way, our solution, I call it. This is a beef stew. We call it in Jewish. A lot of Jews call it a cholent. It's a sign of food we have. You mix beef and potatoes and beans and mix it all together, and it comes out pretty tasty. Believe me, I had it last week. So this is what we do. In our portfolios, we actually do combine. Now, why am I saying this? It's not very, we'll get to that in 1 second, because we have another combination here. Most investors that you'll probably learn about started off buying the deep value stocks. Monish Prabrai, any of you heard of him? He's also a great investor that started off with buying the nets and the crappy companies, and today he's looking for the 100 baggers. So this is an evolution of many investors. From our solution, and I'm not saying this is the right one, I had a tough time choosing, so I do both. And there's certain advantages to doing both. By the way, when you're managing small amounts of capital, doing the deep value stuff works. I think most of your professors will agree with me. It works much better on small and micro cap stocks, okay? It also works on large cap stocks over time. In the past 10 years, none of it has worked. Yeah, value investors have looked bad. But also within the micro cap world and the value strategies, you have to be very careful because you fall on a lot of crappy companies which are deserving of a small price. So what we do is from another book. Again, I'm not expecting you to go read all these books at once, but at least you know these names. James O'Shaughnessy wrote a great book many years ago called What Works on Wall Street, where he also looked at stocks and used various value metrics to see what strategy would work best. And he found that the best strategy is not to choose one parameter, is to use 5 various parameters of value. As you see them here, price to earnings, price to book, price to sales, EB to EV, and price to free cash flow, and find stocks that on total are cheap, okay, and he did this on micro caps, with one extra thing we'll talk about in a second, and his returns were above 18% a year. So we see this works not only in Greenblatt's life and Buffett and Graham and others. What's beautiful about this strategy, which we implement as well, and you also put in something called momentum. You guys learned about momentum. It's another factor that works pretty well over time independently and also within value works great. When you're looking for value stocks, which in the past year have risen above, have had a positive return or above the market, depends how you do it. If you mix, again, remember our beef stew, you're throwing in different ingredients, and sometimes if it makes sense, it works well. Meaning what's the problem with value stocks? Sometimes you get stuck with a stock that's a falling knife, that's a really crappy company that's going down all the time. So momentum helps you overcome that. And by the way, remember one important thing here, you're not buying these stocks and not selling them. This is a rebalanced quarterly. We even rebalance monthly. How can we do this also how can I rebalance monthly and call myself a value investor? I must be trading all the time. Because we do this also within IRA portfolios where the transaction costs are low. And one key thing, one of the things that Buffett hates paying is what? Taxes, exactly. So when you're doing an IRA portfolio, you don't have the tax issues. So that's another thing to talk about. One last advantage I want to talk to you about that I just thought about this morning when I landed. One of my investors called me, and this is a guy that I've managed his portfolio for like 5 years. He's done pretty well. I did this strategy, only this strategy for him, and he's done about almost 40% a year for the past couple of years just doing this. But the 40% compounded annually. Most of the returns came in the first year and the second year. The past 3 years, the portfolio's gone nowhere. Now, this guy has the chutzpah to write me a message, and I'm not even at work, tell me, okay, we have to re-talk about this strategy. It hasn't been working for the past year and a half. Oy vey, bad news. Okay, this guy's made so much money, but the year and a half his portfolio has gone nowhere, and the NASDAQ has gone up, he can't sleep well at night. That's the problem with these strategies. They don't work all the time. So in order to stick with it, either you have to not look at the portfolio, not touch it, which you have to touch sometimes. But the beauty, I think, what we try to do is to implement it when we have a portfolio with the values, the compound, the Oceanasi strategy, together with compounders, wonderful companies at fair prices, and we do this within one portfolio. So you have sometimes this does well, sometimes this does well. So if you're going to manage money for other people, you have to make it's a tough job, and of course you're not always going to beat the market, but you can't, if you want to, make a living, you have to look somehow. You got to look okay. I'm not saying you got to. Of course, you got to maximize your returns, but you have to, as they say, to finish first, you must first finish, right? So your investors have to be able to cope with this experience. So that's why, together with the value stocks, we've mixed Fairfax Financial. We have. I heard Thomas Gaynor from Markel came to speak here. Another great compounder we have in our portfolios. Another one, Rick Hospitality, is a great company to keep on your watch list from the States. I gave you a free seal acquires. That's why we do it. Okay, I'm enough talking for me. I just want to give you a few recommendations of reading material if you want, and any other questions you have. If you want to read about how to find the next 100-bagger, wonderful companies at fair prices, of course, read everything Warren Buffett has written on the subject. But Christopher Mayer, anybody heard of him or read this book? There's an original 100-bagger book that actually in the 1970s checked what was a common denominator, or looking for common denominators of stocks that their price went up from $1 to 100. And he took out Biomed stocks, all the lottery stocks, and you wanted to find real businesses that over time went up 100. And there are many things that are commonalities between them. So the best book to read on that is a subject. I would highly recommend this book as well, also recommended by Warren Buffett. William Thorndike wrote a great book called The Outsiders, talking about 8 management teams of companies that have had the share price of these companies have been above the S&P over time, and also it's like a story. Very readable book. After this book out, it's actually become a phrase in the investing circle called outsider CEOs. Remember management teams that think outside the box? So when you find a company, read their CEO is like an outsider, or meaning in reference to this book, then you'll know that you're talking about a great manager. So this book is very recommended. A few investors, I tried to make you a list of ones that are not well known. Actually, I have a few to add to you on the flight over. I had a few others, so just going over them. Chris Mayer, that wrote the book, is a great. Adam Wyden, some great, really smart guy. I think he works in Florida today. Cliff Asness from AQR, he's a huge investment firm. He's a quant. He's doing most of the strategy we talked about in the beginning. Scott Miller from Greenhaven Road, Chuck Acker, we talked about. Shriv Riswantans from SVN Capital. I'm actually going to go meet him tomorrow. Hopefully, he's not well known, but the formula, finding these companies with reinvestment, he's great at doing that. 3 others I wanted to tell you that weren't here. Murray Stahl from FRMO, you haven't heard of him, from New York, really one of the smartest, one of the best out there. He had one stock, by the way. How are we with time? We're okay? He has one stock called Texas Pacific Land Trust that we own as well. He bought it when it was about $10. Today, one stock is worth up about $2,000, and it makes up over 30% of his fund. One stock. He bought it, and all he's done over time is maybe added a little more. Never sold. Murray Stahl, we said. Another guy called Dan Rasmussen from Verdad Capital. I see a few. He's one of the best out there. I highly recommend following him. What was the third name? I wrote it down, so I won't forget telling you. No, this one we talked about. Oh, yeah. Chris Bloomstrand from a fund called Augustus Sumptus, where he writes annual letters that are about 150 pages long, and he's like I think he knows about Berkshire more than Warren Buffett knows about Berkshire. He's a great, really smart guy. I highly recommend listening to him. All these guys also, you can find podcasts, read their letters online. Highly recommended. That's it for me, guys. I thank you for listening. Thank you for coming. You're more than welcome to come visit us in Israel if you if you want to see a beautiful country. A bit of turmoil right now, but it's still a great country. This is my email if anybody has further questions, wants to talk, discuss. I'll be more than happy. Have any other questions? Feel free now. Feel free later. Tom also knows how to find me, and I'll be more than happy to answer any questions you may have. I hope you enjoyed it for now. And I hope the English, I didn't make too many mistakes. Don't quote me on anything, because again, 3 o'clock in the morning. When we watch, I'm a big sports fan. We want to watch like NBA games from Israel. We have to wake up now to watch Steph live. So this is the time I wake up. So now I can answer questions, if there are any, of course. Yes, go ahead, sure.
I have some questions, but not related to investing methodologies, more related to your career path.
Yes.
That is also okay.
Yeah, of course.
I want to understand, how did you transition from lawyer to a hedge fund manager?
Okay.
And when you set up your own firm, what is the biggest challenge and how do you overcome?
Great. Yeah, I didn't talk about that too much. I try to not talk about too much about myself. But yeah, I was just about as a lawyer, I went to study law just so my parents would be happy, and I was probably the worst lawyer ever. So it didn't take too much to understand that I was not going to stay as a lawyer. I found I wanted to look for something that I loved. Okay, and this is probably the biggest tip. It sounds cliché. How do you say it? It sounds like cliche, but you want to work in something you love. Okay, and when I was studying for my MBA, I actually had a professor who studied at the Booth. Studied there at finance with Fama and French, and he kind of started talking about investing and kind of interested me. Like all the other classes, I had no interest whatsoever. This I liked. Also in law school, by the way. So and then I started reading about Buffett, and then it just became like it became like something I had to do. It was pretty like a no-brainer. I quit my job, and I started studying for the exams to become a licensed portfolio manager. You got to put yourself out there. It wasn't like I sat at home and did nothing about it. Also, when I got fired because they ate my fish, I did sit at home, but I made phone calls, cold calls. I heard about a great investor today that he said when he finished studying, he just made a list of all the investors he took from then the yellow pages, and then he found the ones that invested the way he wanted, and just cold called all of them. Again, I don't know how it is today in the workforce in New York, and it's large and so many options. But to put yourself out there and follow your passion, and you asked, and what you learned.
Set-up question is what is the biggest challenge in
Challenge.
setting up your own?
The biggest challenge when you set on again, the path I did is not conventional. I highly advise it for most of you. Probably stick around and work at like an established firm for a couple of years and set up your own, first of all, manage your own money, see that you know what you're doing, and then you can have a track record. But the biggest challenge is getting people to invest with you. That's really tough. Like when I started, when I had nothing, like I started with my father and my brother-in-law, my sister, whatever, but how are you going to get other people to invest with you? So we talk about Steph Curry. So I had a lot of friends from basketball, and they said they knew I could be relied upon sometimes to make the three-pointers. So they said, okay, maybe he knows some investing. So my friends, and then family, and then and I showed you returns from when we had the fund. In the beginning, like all of our investors, we looked like idiots. But I kept talking to people, long-term, 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 long-term. And we also have a podcast today, where I talk about investing in Hebrew. So I'm not sure any of you want to listen. That would be interesting. But we also got a podcast. So I wrote a few papers, articles in the paper, and so a lot of there's not one thing, but as I said, do what you love, and then try to convince people that you know what you're doing and manage your own portfolio. See that you can stick with it, because all this looks great on paper, but if the stock market goes down a couple of days in a row and you're losing your head, none of this is going to help you. You need to keep your head, your emotions. That's why one other reason why I like the mechanical strategies, the deep value ones, because you need to stick with it, and over time, it should still work. Thank you for the question. Yes, I hope I answered.
From over your letters, and it seems like the microcap kind of lean.
Yeah.
What are like the unique constraints of running a microcap fund versus like maybe a small cap? Like how do you
Yeah. First of all, I'm not. The constraint I can do my fund as long as it's an equity and I can invest in it, and so it's not. I'm not. It's more a constraint. I really still believe that the micro caps, again, the value. If you do value investing well on micro caps, it works probably the best because you have less competition. You know, at Apple, everybody's looking at what's like. We have one company called HOV, Hovanian Energy. It's like, I want to give it as an example. Didn't want to give you more, but it's gone up a couple 100% since we owned it. It's nobody's heard of this stuff. So I think as long as you're managing smaller amounts of capital, again, this goes to answer the paradox. I think even Warren Buffett, who start off today, despite the sentence he tells us, I think he said it before in one of the annual meetings. Buffett, I think, said if he would start again today, even though Charlie Munger says it doesn't work so much. Again, a lot of contradictions, but Warren Buffett himself, I think, would go back to do the nets, the microcaps. You're not going to find, what's your name? Gary? Yeah, so Gary, you're not going to find like a large market. Facebook, as cheap as it got last year, it wasn't even close to being a net. If you want to buy the real cheap stuff, you're probably still going to need to go like $500 million south, and a lot of this stuff doesn't. You don't have to invest only in the U.S. You can find a lot. Japan has a lot of good stuff today. Dan Rasmussen writes about it. So just have an open mind, and if the market crashes and all the large cap stocks become cheap, fine. We'll go there too. But I think that's where most of our higher returns have come from, the stuff that nobody else looks at. Good question. Yes, please.
Do you do any other strategies like merger arbitrage or because
did you read my annual letter? What is this? You're cheating.
Oh, no.
No, you're good.
Buffett's
What's your
early
name?
partnership, Alan.
Alan, nice to meet you.
Nice to meet you. His early partnership, he adds a portion of his book in merger arbs, and outright and sometimes partial control situations. And I tend to think that having those different strategies, including the generals that he called it, like the generally undervalued stocks.
Not related to the market. Yeah.
Exactly. Shielded volatility.
So when you come in Israel to help us out finding these, you're absolutely right. Thank you. And we do that as well. I did for in an hour talk. I didn't want to give you too much stuff, but I wanted to give you the. Yeah, but in my annual letter, I also write one. Of course, totally different scale than the great investors, but we have a third category. And if you guys know Seeking Alpha, a great website to use and read about stocks. So you can find my annual letter there too, and you'll find a third category. And this is exactly what you said. So yeah, great minds. I agree with you completely. Yeah. Thank you for that. Yeah.
Do you set any boundaries?
Well, wait, sorry, by the way, I didn't explain it. Did everybody understand? Sorry, what Alan said, he was right. Sorry, 1 second. That a third category is merger arb, when a lot of times when one stock is buying another public company, then many times the market price of the company being acquired will shoot up, but not up to the price totally. Like a great example would be last year or this year, Microsoft bought Activision. So you own that? That was a lot of good managers owned that. So even when Microsoft said they were going to buy Activision, I think it was like at $92 a share or something like that. Doesn't matter?
No, it was actually at like 55. It shot up to 75.
So, no,
but they were buying it at 95.
Yeah, exactly. So the final price was in the 90s. But despite this fact, the price traded up, but not up to the price. And Buffett himself bought Activision stock because and a lot of the market thought that regulatory reasons the deal would be shot down. At the end, it ended up being finished. And whoever bought Activision, even after the merger was publicized, made, I don't know, like a 50% return. It was like really, really high returns. And these kind of deals can be found all the time. And the beauty, what Alan is saying, these deals have very little correlation to the market. The market could have crashed, and the Activision deal would have probably still been completed. So that's another third category to soften, dampify the volatility. Great, thank you. Yeah, sorry, back to you. What's your name?
I'm Stacy.
Nice to meet you.
Nice to meet you. So I actually want to ask you whether you set any boundaries of your investment, because I know some professional investors, they only invest in certain markets that they are pretty familiar with.
Yeah.
They only invest in certain industries that they think have enough safety margin. or something? Do you set that boundary?
Again, there's no right answer here. Each one of you, when you set off your own investment career, you'll find your own way. But within the markets, I do most of the stuff in, like, as I said, Japan, the U.S. Nets I can find in Europe, but I won't invest like in countries where there is no democracy or you can't trust the numbers. I don't want to offend anybody, but China has there's a long history of many companies there. Like the books sometimes might not really represent what's going on. So I have a problem sometimes investing there. You need to make sure you can trust what the companies are. Like if the company's writing the balance sheet says it's a net, but it's really not, and it's happened many times. And so you want to be careful with your markets. So I invest all over. With the compounders, with the industries, and this we didn't talk about today. I mentioned serial acquirers, but there's really one. If Warren Buffett's returns can be boiled down to other than the value investing principles we talked about, there's one thing that really magnified his returns, and it's one industry that's probably where, if you want to look for compounders, that's where I look. Okay, you guys do whatever you want, of course. What is this industry? What really made Buffett? What amplified his returns? There's been studies that's shown that it's actually the numbers have been. He's leveraged himself to the market by about 1 to 1.6, meaning if the market returned 12%, Buffett did about 18 because of this one factor. It's leverage. How did he get leverage from one industry? Insurance, exactly. So if you want to find a great compounder, like I mentioned Markel, Fairfax, these are insurance companies. Again, they have the reinvestment capability. They have a good insurer. No, I'm not saying this. Remember the book, The Outsiders, I recommended. William Thorndike said this. If you find a combination of a good insurance company, good, not many insurance companies are not good. A good insurer and a good investor together in one company, that's a combination that can make wonders, and it made wonders for Buffett. So to answer your question, I love great insurance companies all over the world. We have another company from Norway called Protector. Insurance company. It's gone up like 4 times since we bought it. Again, I'm not recommending anything, but I hold it. And they also just took the Buffett playbook. What do most insurance companies do with the money they have laying around? They invest it. You guys are still with me? If you want, you guys, whoever is not interested, feel free. Of course, I know the late hour. It's late. They can, and I appreciate your questions. It's fun talking about this for me. So they take the money and they invest it in bonds. They invest it in really, really safe stuff. Buffett and these other companies I talked about, they take some of this money. Buffett took a lot of it, invested it in equities. So you're getting the insurance, you're making money from the insurance and from the investments. If you do both these things well, you can get a chart that looks like what Fairfax has done. Again, very hard to find these, but when you find one, hold on it for dear price, even if it's a little expensive. That was what I was trying to tell you. Any other questions? Yeah, sure.
What's your personal or your fund strategy research process looks like when you find a name that you like?
Okay, first of all, so I introduced, I also have a partner that works with me who couldn't make it all the way here. His wife is supposed to have a baby, so we work together. But I think many of the great investors that I learn from, they don't have committees and they don't do that stuff. They sit most of the time. They have a Guy Spear. Have you heard of him? He's another great investor. He wrote a great book called, what's the book called? Yeah, great. It's a good book. So he talks about it. He has like a room where he goes to read. Monish Prabhai likes to have his naps in the middle of the day. Again, these people are not hireable. They're great from. They do whatever they want. So like them, I work on mostly on my own investment decisions that I make. What I do most of the time, what's your name? John. Why did I give you guys a list of these great investors? Because most of the day, I like to read and discuss with these great investors and others. I see what they buy, and it gives me a source of great material. So if I see that Chuck Akre bought a new company, I'm going to make sure and read about it, and I will read their financials, and I will read their history, and I'll look into it. That's how I start. I don't come up. Moniz says, be a shameless cloner. You don't have to make up your own ideas. see what other great investors are doing, and then you can copycat. But the first part, the nets, I have screeners. It's a mechanical process where I just got it this morning. I have I don't know. I'm not very good technologically, as you see. So I took the strategy that I talked to you about here, and actually a guy who has a great investment blog called Investing for a Living. We developed a strategy based on this one, and he uses a site. No secrets. You see, the great investors, guys, they don't secrets. You want to share. You have a great idea. There's no reason to keep it a secret. So there's a website called Portfolio 123. It's more for those of you who are more technology inclined. But so it's a website where you can like set up your own back testing and see, okay, what would happen if 30 years ago I would have bought all the stocks with the letter P or the ones with the low price to free cash or whatever, and you can do whatever you want and see what would happen in the past. Again, you got to know what you're doing. So this guy gives me once a month a list of the stocks that come up on the screener in pretty much this strategy. And this morning he says, okay, this stock you buy and this stock you sell. And you know what I did? I told the guy who does the trading in our fund, buy this, sell this. I didn't look into it. It's pretty amazing. But one more anecdote I will tell you. Maybe this is a take-home message. Again, it contradicts everything you learn. But Joel Greenblatt, when he wrote the Magic Formula book, he had two teams running the formula. One team would buy all the stocks, I think I mentioned this, buy all the stocks mechanically. Other team, from the 25 stocks that came up on the screener, started doing their homework, analyzing what's better, what's worse, and you know which team did much better over time? The one that bought mechanically. Again, what's the reason? Because the really good, if you want to buy like the deep value stocks, Professor Wesley Gray says, when you buy a value stock, if your stomach isn't churning like, what am I buying? You're not buying a value investment. So that's why the analysts who were analyzing couldn't buy the ones. Like there was one stock that everybody shorted, Herbalife. Okay, came up on Greenblatt's screener for many years. It returned a great return. Everybody was saying it was a pyramid scheme, and it was still, the stock was so cheap that it turned out to be a pretty good investment, I think. So this part, what I'm telling you, I do mechanically. So this morning I got the list. Today we bought and sold, and that's it. And until next month when we do rebalancing, I won't think another thing about these stocks. Yeah, again, maybe one or two more questions. I want to let you go. But I'm here if anybody wants to talk later. Sure, go ahead. Yeah.
I'm just curious if you have any experience or thoughts on applying value investing to private companies.
Yeah, value investing in private companies, but you don't really know. How would you value? What do you mean, like valuing?
Just using a lot of the value investing principles.
Yeah, of course it works. Actually, I mentioned Dan Rasmussen. He does a lot of work. He says private equity. That's what they do. They just buy private companies for good prices. They leverage them up. They take high fees, and they're just. But really, what they're doing is just value investing on. So again, when you buy at the end of the day, the price matters. Again, I showed it as a contradictory, but I think I told you again, the price is when it doesn't matter what you buy, whether it's diapers, a private company, a public company, or I don't know what, dog food. If you're paying up, unless you got a real beautiful compounder, you're always going to be better off paying less. So it should work. But again, I don't do private companies. Again, we don't have access, and there's a lot of investors love the private markets today, I know, but we don't do that stuff. But it should work. There's no reason. Yeah, last question. Sure.
A lot of these investors, like Buffett or right, they mentioned not having to use Excel or models to understand the business.
Definitely. Yeah, definitely. I was thinking I wanted to. I don't even know how to. My basic technology of Excel is not my thing. Again, as I told you about Fairfax, when you try to value such a thing, like if a company can increase its value by 18% a year, how are you going to value that? Like it's really, most of the valuation of a company comes from the future, and Excel is, after I got fired from the fishbowl investment firm, I was hired at a different one, And they did value investing using Excel sheets. And it works fine, it looked all great, until the point where you have to say, okay, so how do I, what's my denominator? How do I, okay, the company's gonna grow 10% a year, how do I price that today? What is it worth? You know, there's you probably guys are learning, you learn how to do the DCF, right? You guys have that stuff. But some investor called it, it's like the Hubble telescope. You change the numbers a bit, and you're in a different universe. So it's very hard. So what Chuck Akre does, he says, okay, I think he does what's called reverse engineering. Michael Malbison, does he still teach here? Yes. Okay. So he has a great book on it. It's called I forgot what. He's got a few good books, but he wrote a book where I think.
Well, then you know.
What?
Well, then you know.
Yeah, that's a good one. But the book I'm talking about is different.
Expectations.